Happy Monday, everybody. First of all, on behalf of Mr. Engels and myself, I want to thank everyone for the hard work you did last week. Mr. Engels and I were talking over the weekend, and we felt like you guys were really putting in some hard intellectual work to try to kind of figure this stuff out, and it's not easy. So we just want to say we really appreciate the work that you've done. In looking through your stock or bond recommendations, Mr. Engels and I, we noted a very clear trend that the vast majority of you were recommending the bonds that you had researched over the stocks that you had selected for your game. So the question is, well, why is that? And a lot of the rationale was the same, was that a lot of you thought that right now, given what's been going on in the stock market, may not be the best time to put a lot of money into it given the wide range of prices and their general downward trend. And so this is a discussion that's happening in the real world right now, and you can find article after article having this discussion of where should investors put their money. So one of the things that a lot of you noticed was that there was this huge range in prices within the stocks that you researched. The term that describes what you're talking about there is actually called volatility. If you think about the word, a person can be volatile, meaning their emotions can rage wildly from one direction to another. But the same thing can happen with the prices of stocks. So to define volatility, we're talking about how quickly and how wide of a range we see stock price movements, which helps us to understand to a degree how much risk and how much potential reward there is in investment. For those of you who are still kind of working hard at trying to do well in the stock market tournament, there's actually a term for this in the stock market world. It's called a stocks beta, and it's a statistic just trying to use again, it's recent price range and how much the stock's price has changed over time compared to stocks as a whole. Definitely stocks as a whole recently have been kind of a scary investment, but the beta allows you to compare one company's stock movements to another. So the statistic, the higher a company's beta suggests that it has greater volatility or more movement in the price. If the stock's beta is 1, that means has about the same volatility as the market as a whole. And below 1 means that it's essentially more stable. The stock price is more stable than the market as a whole. So for example, General Motors has a beta of 1.54. Again, on its own, 1.54 doesn't mean much. But if you compare that to the company Yeti, Yeti has a much higher beta. It's one of the higher ones, probably among better known companies out there. So Yeti's stock price tends to move much greater than General Motors. From this perspective, General Motors is a safer investment, but Yeti carries more potential for a high reward. If we look at another company you might be familiar with, we've got Hershey, and their beta is far below 1, suggesting that their stock price in recent history has been much more stable even than General Motors. So if you're looking for an investment in a stock that, at least in the past, has had kind of low risk, Hershey might be a good investment. Of course, that also carries with it a lower reward. So trying to make sense out of what you're seeing in the real world based upon your own observations and your research, here's what we think we've been seeing. As the stock price as stocks have become more volatile, people have gotten nervous and they're trying to pull their money out of the stock market. If you look at the chart on the left, it's a very simple supply and demand graph going on. We see a leftward shift of demand, so demand is decreasing for stocks, which is driving stock prices down. So stock prices are falling, people are putting their money out, but they want to put their money somewhere else. So if you shift to the right side of the screen, one of the things that you're seeing in the real world and seeing with your decisions was that people are putting money into investments that have less risk, like extremely highly rated bonds, those AA's and AAA's. And what you see on the chart there is there's an increase in demand for those kinds of bonds. And the effect of that is the bond prices rise. Now, this is something we haven't talked about yet, but you actually saw this in your research. So that list of different bonds that you see there should look familiar from the research that you did back on Tuesday. And you see the coupon rate, you see the maturity, you see the ratings. Get my pointer here. You see the coupon rate, the maturity, the ratings, but you also see the price of the bond, and you also see something called its yield. We're going to try to make sense out of that a little bit. So When a person buys a bond, they don't have to keep it until the date of maturity. I could buy a bond today from Target and decide tomorrow that I want to take my money out of that bond and reinvest it somewhere else. So a person who buys a bond can decide to turn around and resell it as long as somebody else out there in the world is willing to buy it. Most bonds, when they're initially priced, their par value is either $100 or $1,000. These bonds from Target all clearly had an initial par value of $100, but you see the price that people are willing to pay for them has changed over time. In fact, if you notice, all of the prices are quite a bit higher, with one exception, quite a bit higher than their initial par value. So the previous slide that showed that prices were probably rising for bonds, you see that right here. People are pulling their money out of the stock market and to some degree putting it into the bond market. Now, this idea leads to what we call yield. So again, what we see is bond prices, they can rise or they can fall depending upon the demand for those bonds. When the prices change, however, the coupon rate does not change. The initial amount that companies were willing to offer to the purchaser of the bond, that's going to stay the same. That's written down on the piece of paper. The maturity date stays the same. If a bond was due to come to maturity in 2031, if another person purchases that bond, that doesn't change. That remains the same. What does change is what, again, we call the yield. That's how much or what percent of a return an investor is going to get on a bond. Well, it's going to depend how much they paid for that bond. So how much a person pays for a bond is going to change how large of a return the investor receives. And this is what we call the yield. And we see different yields over here. And this is different than the coupon rate. This is written down on paper. This does not change. But the yields will change depending upon how much people paid for the bond. So a calculation of a bond yield, it's how much the person who holds the bond will get per year in payment. So if I have a $100 bond with a 5% coupon rate, I'm getting $5 a year. And that's going to be divided by how much the person actually paid for the bond. So an example here. Let's say that you hold a bond, and based upon the coupon rate, you are getting $7 in annual payments off of every $100 bond. But if you paid $115 to get that bond, the result is that your yield will actually be lower than the coupon rate. Again, the reason a person might do this bond still might be a better option than other bonds out there, and it might be safer than something else. So the result of this, and this is what we see as a pretty general rule, when the bond prices rise, like we've seen lately, the bond yields fall. When you pay more for something, you get the same dollars back, but as a percent of your investment, that's going to be smaller. And on the flip side, when bond prices fall, bond yields rise. So if you pay less, you get the same number of dollars back, but the percent return on your investment will be higher. We're going to walk through a pretty simple scenario here. So let's say that there's a company out there, let's call it the Engels Company. No reason. Let's say that they issue a series of bonds to try to raise money. They want to start a chain of hydroponic beet farms. S&P, they look at Engels Company financial records and their prospectus, and they give Engels Company a bond rating of B-. If you remember, that would be a pretty low bond rating. And so Engels Company has to offer a 5% coupon rate in order to get investors to buy the bonds. So let's say that Michael Scarn goes out and purchases Engel Co. bonds in 2019. He purchases a bond for $100, that's par value. There's the 5% coupon rate. It's due to come to maturity in 2022. And its yield is going to be 5%, the initial coupon rate, because Michael Scarn is going to receive $5 per year out of every $100 bond, and that's what he paid for it, so that's his 5% yield. Now, let's say that in 2020, for some reason, the stock market collapses. More people are some people are looking to put their money into less risky investments, like you guys suggested, which is going to drive bond prices up. But there also might be other people out there who need their cash right now. They need more liquidity. So they can choose to sell their bonds to other people. And that's what's going to happen in this case. Michael Scarn is looking to sell his bonds, and Holly Flax comes along and buys Michael Scarn's bond. Now, for Holly, though, because a lot of people are trying to buy these bonds, she's going to have to pay a higher price to get the bond. Essentially, they're bidding against each other to get this bond. The coupon rate will remain exactly the same. The maturity date remains exactly the same. What's going to change, though, is the yield. The yearly interest payment, that's going to be the same, but the price that Holly paid is going to be different. So she's still going to receive the same $5 per year off the initial $100 bond, but because she paid $110 for it, if you do the math, trust me, that results in a 4.5% yield. Now let's go to the next year. Let's say that a year from now, the stock market is looking like a better investment, and Holly decides she'd rather take the cash out of the bond and invest it into the stock market, which she thinks is going to lead to higher returns. So she can choose to try to sell her bonds, and lucky for her, there's somebody who wants to purchase it. It's Jimothy Halpert, and Jimothy Halpert is going to go and purchase those bonds. But if there's a lot of people out there who are deciding they don't want to hold bonds anymore, that's going to reduce the demand, which is going to drive down the price. So Jimothy Halpert can purchase this bond for $90. Again, the coupon rate has not changed. The maturity date has not changed. What will have changed is the yield. Jimothy is still going to get $5 back. However, he only paid $90 for that same bond, which means that his yield, his rate of return that he's getting is higher than what Holly was getting, and it's higher than what Michael Scarn was initially getting. So what you're seeing in the real world right now is this balancing by investors of deciding where they want to put their money. One of the strange things that was happening over the last few weeks that was making some investors really nervous is that stock prices were falling at the same time, at least for a while, that bond prices were falling. That suggests that investors in general didn't want to invest in anything because of uncertainty. So we just wanted to do this so you could make some or try to apply what your ideas for investments, how those were applying in the real world.